Hey examinees, welcome to another past paper walkthroughs. Today we are working on question 18 from Edexcel IGCSE Accounting May 2024 Modular Paper 1. In this question we have a purchase along with a disposal, so we are going to see how to tackle that. The question requires examinees to prepare cost, provision, and disposal account, so we have a long way to go. So we start with our usual steps. Step 1, we make note of the date of sale and date of purchase. The date of sale of this question is July 2023, and the date of purchase is Jan 2022. We also write down the sale value of $15,000 and cost value of the sold asset here so that we can conveniently do our workings. In step 2, we figure out the number of years the asset was with the Ozan. To know that, we start with the year end, which is 30 April 2024. Then beginning of the year is May 2023, so our current year is May 2023 to April 2024. The previous years would be May 2022 to April 2023. We need to reach Jan 2022, for which we have to take in another year starting from May 2021 to April 2022. We get our date of purchase of the sold asset, so we stop here. In total, the asset was there with the company for 3 years. However, the assumption that no depreciation in the year of sale eliminates the need to calculate depreciation for the current year, which is year 3. Therefore, we have to calculate depreciation for 2 years only. We move to step 3, where we calculate the provision for depreciation for the sold asset. The method is reducing balance, so we use the equation cost minus provision multiplied by percent. We take cost of the asset sold, which is $28,000, and provision is 0 as the asset is new, and then we multiply by 25% as the percent given in the question. We repeat the same for year 2, but we have the provision. The provision is basically the depreciation we just calculated in year 1. Therefore, we subtract $7,000 from the cost, $28,000, and multiply by 25%. We get $5,250. The provision for depreciation is the total depreciation, so we add depreciation of year 1 and year 2, and we get $1,250. This value goes to provision for depreciation account as disposal, and disposal account as provision for depreciation. In step 4, we calculate the depreciation of the unsold asset for the current year. The same equation for reducing balance is used. We do not have the cost of unsold asset or the provision of the unsold asset, so we first calculate them separately before substituting in the equation. To get the unsold asset cost, we subtract the sold asset cost from the total asset cost. The total asset cost is $96,000, and sold asset cost is $28,000. Do the math, and you get $70,000. Now, come to provision. Subtract the provision of sold asset from the total provision. The total provision is given in the question where they mention the balance in the provision account. We can see that here, $40,250. The sold provision is the value we got in step 3. Do the math and you get $30,000. Now, take these two values, $70,000 and $30,000, substitute in the equation and multiply by 25%. You will get $10,000. This is the value that usually goes to provision account as income statement. However, we have a new asset purchase in this question, so gotta account for that as well. We extend step 4 by calculating the depreciation for this new asset, so do cost minus provision multiplied by percentage. It's a new asset, so provision is 0, and you just multiply the cost, $42,000 by 25%. You get $10,500. The value you got earlier, $10,000, add that to $10,500, and you get $20,500. This is the value that goes to provision account as income statement. We then move to step 5 to calculate the profit or loss. We use the equation sale minus cost minus provision for depreciation. The sale value given in question, $15,000, cost given in question, $28,000, and provision, what you got in step 3, $12,250. Do the math, you get negative $750, so it goes to credit side of disposal account. Now we move in to make the accounts. We start the cost account with balance BD on the debit side, which is the balance in the cost account given in the question, $96,000. Then we write the asset purchased, $42,000, as cash book on the debit side as it increases the value of the asset. Lastly, we put the disposal, $28,000, on the credit side as it decreases the value of the asset. We then calculate the total. Put the higher side total on both sides, then find the difference on the lower side. This difference, a $110,000, is brought down as balance BD. Now put the dates. Balance BD is beginning of the year, May 2023. Disposal is date of sale, July 2023. Cash book is November 2023. Balance CD is end of year date, and balance BD is beginning of next year date. We then move to provision account. We start the provision account with balance BD on credit side, which is $42,250. Then we put the income statement from step 4, $20,500, on the credit side. Then we post the step 3 value, $12,250, on the debit side. Then we calculate the total on both sides. The higher side total is credit side, and we put this higher side total on both sides. We then calculate the difference on the lower side, then bring it down. Now put the dates. The balance BD is beginning of the year date, April 2023. Disposal is date of sale, July 2023. Income statement is year-end date, April 2024. Balance CD is year-end date, April 2024. And balance BD is beginning of next year, May 2024. Now move to disposal account. Start the disposal account with cost assets sold off, which is $28,000. Move to credit side. Post the provision from step 3, $12,250. Sale value $16,400 as cash book add loss from step 5,750 on the credit side. Add both side and it should be same. Now put the dates.